Hello and a warm welcome to Econoday Unplugged on Thursday, the 20th of July 2023. Terry Sheehan is on US East Coast, Max Sato is in British Columbia, Brian Jackson is in Sydney. We're hoping, not sure if he can join us yet at the moment, and I'm Jeremy Hawkins in London. Holidays, and hooray for them, mean it's been a few weeks since our last podcast. So in today's edition, we thought we'd provide an update on where the major economies now stand, and at least as importantly, what to look forward to going forward, which means then there's a lot to cover, so best we get on with it. Right, Terry then. So how's the US economy shaping up now, and have there been any significant changes since we last spoke?
Well, so far, the U.S. economy is actually looking pretty good. For the second quarter, 2023, the early GDP nowcasts are looking for growth somewhere between 1 and 2%. That's actually much better than was originally forecast. We're seeing fairly solid retail spending in the April to June period. The inflation data is moving in the right direction. The CPI for June was up 3.0% year over year. That compares to an up 4.0% in May, so that's a significant improvement there. Less positive is what's going on at the core, which was up 4.8% year over year, but that was improved from the up 5.3% in May. So inflation's moving in the right direction. The labor market so far is looking pretty good. We had a decent monthly employment report. The unemployment rate remains historically low. We're seeing relatively few layoffs. We are seeing elimination of a lot of open jobs, but businesses are not laying off workers unless they absolutely have to, because they don't think they can replace them later on. So overall, the supply and demand imbalances in the labor market are improving. So actually, Fed policymakers have a lot to like when they meet next week.
Okay, well, I'm not sure about that. It sounds from what you're saying, it's looking like a kind of, well, a soft landing really scenario as far as the US is concerned. But as we've gone through the course of this year, there's been different people in different parts of the US and around the world talking about, there's going to be a US recession at some point during 2023. Do you think that's still a significant risk, that's something investors should really be looking closely at? Or do you think now the probability is sufficiently low that really we can look towards, continued growth throughout the rest of the year?
Well, I hate to jinx it by saying that, but so far the U.S. economy has been resilient. It may be having slow growth, but it is having growth. It looks like the increases in household incomes have continued, and with inflation slowing down, that means the prospects for consumer spending remain pretty good for the rest of the year. There are some really tentative signs in some of the surveys of manufacturing in the service sector that they look like they've bottomed out. The downturn in the housing market looks like it's bottomed out and it's in fact rising again, because despite relatively high mortgage rates and elevated prices, people are looking to buy homes right now. So there's a lot. I wouldn't say we're going great guns or anything, but it looks like we're keeping a recession at bay for now.
Certainly seem to be outperforming a lot of the rest of the world. Okay, you mentioned Fed policy or touched on Fed policy briefly earlier. Let's have a look at that. And we've had the Fed has risen or hiked interest rates by 5 percentage points or so since March last year. You said that the inflation numbers for June were, let's be honest, pretty good and certainly softer than expected. So although if I've got it right, it seems that despite expectations for Fed policy literally being all over the place as we've gone through 2023, there's still a general consensus that we will see interest rates being hiked again next week. Given what you said, do you think we're perhaps now getting to the stage whereby another Fed interest rate hike might be one too many, or do you think it's the correct thing to do?
I don't know if it's going to be one too many. Fed policymakers have been pretty consistent in warning that the downward path of inflation could be uneven and there could still be some episodes with prices going up again. We have to look at like what's happening with the ports in Ukraine, unable to ship out food items. We may see another spike in food prices. So, this kind of stuff can still happen. I personally think that Fed policymakers are going to keep the pause next week. They've got enough data to suggest that inflation is coming down. They do not want to hurt the labor market. And they might think that, one more 25 basis point increase isn't going to make that much difference. But I think they can see an opportunity here to extend the pause at least through September when they have more definitive data. And they will also be updating their forecast for the quarter. So I think it's very likely they will actually pause next week. I think they will have very strong language that we shouldn't rely on that remaining the case. And I also think we're going to hear a lot of talk about how policy is going to remain restrictive for longer. But I think at the moment, they may actually, they often say they're data dependent, and I think the current data could counsel that they should hold one more meeting.
Okay, that's interesting. Now, let me ask you then, if you think that we do see the Fed not choosing to not do anything next week, do you think that could actually mean the top end to rates, or do you still think there's possibility of one more hike a little bit further out?
I think there's still a possibility of another hike a little further out. I think they're just sort of extending their horizon for possible rate hikes.
Okay, fair enough. Anything else you'd like to put in the pot before we move to Max?
No.
Brilliant. That's what we like to hear. Great. Thanks for summarising that, Terry. Excellent stuff as always. So, Max, let's move on to you and Canada. I guess what the Canadian economy has been, certainly relative to expectations anyway, has been one of the best performing economies, certainly amongst the G7 anyway, during the course of 2023 so far. But we have seen inflation on the Bank of Canada's own admission, not performing as expected. Overall, where do you think the Canadian economy performs now?
Well, I think, like Terry said, economy seems to be fine. The only thing Bank of Canada people didn't mention the last rate hike decision and quarterly outlook was there's a port strike, prolonged port strike in British Columbia, and that could affect economic activity because part of the transportation has been paralyzed. So except for that, growth rate seems to be solid. Labor market still strong, and surprisingly, housing market is picking up now. But the governor did mention that it takes longer for monetary policy to have an impact on consumption, especially consumption on services. So that's why I think they went ahead instead of waiting until the fall to raise interest rates.
Okay, they said, I think in their last statement that projections for core inflation in particular have been upgraded by as much as, half a percentage point or so for the first quarter of 2024 due to what they described as the persistence of excess demand. So do you think, I'll ask the same question as I was asking Terry, do you think interest rates now are at their peak, or again, do you think it's still at this stage anyway, it's more a case of upside risk than the downside risk at some point?
I think, judging from what Bank of Canada people are saying, they're still getting ready to raise rates in case the path from under 3% total CPI down to 2% will remain sticky. So from the interest rate viewpoint, I think the risk is still on the upside.
And can I ask you well, really just feeding into that, I guess you mentioned the housing market. For a long time, clearly the bank has been concerned about an overheating housing market in Canada. And you mentioned now that there are some, at least what I guess tentative signs anyway, that the market may be starting to turn up again. Do you think that's going to be a problem for the bank in the sense that they really wanted to try and dampen down activity there, and that makes it that much more likely perhaps that rates may have to go up again?
I asked roughly the same question to Governor Macklem at the last conference, and then he said the short answer is yes, the bank can still bring inflation back to target while the housing market is relatively strong. It's because, in a way, the bank cannot really influence directly the housing market because there's a shortage of housing in major cities.
Right.
And rents are rising, and people are still trying to buy homes, but some can't because they're just too high. Or I think it's this, missing middle range, housing supply. It's just it's beyond the control of monetary policy, and speculation is still moving the market. So unless a government at all three levels take more measures to discourage speculation through fiscal measures or whatever housing measures, this market's going to stay strong. So I think, like the senior deputy governor said, they're not targeting a specific segment of the economy, for example, housing market. They're looking at it, but it's not a target. So I think they're more concerned about the strength of the labor market, because as Canada brings in more immigrants, they become a new supply source for the labor market. But at the same time, they're going to have to spend the new consumers. So that's going to be a neutral factor for the inflation and growth.
Okay. In terms of a labour market, then, if we look at the June employment report, which we had a surprisingly weak May report, but in June employment was up almost 60,000 or so. But at the same time, we saw at least say a tidy deceleration in wage growth. What do you think is more important now? Is it but the employment numbers or unemployment numbers, the opposite to that, or what's actually going with wages in terms of how the Bank of Canada sees things now?
I think average hourly wages are more important. Unemployment rate can go up. We've had it so low historically, so a little bit of an uptick wouldn't be a problem, and that's kind of slightly bad news is good news for the central bankers these days in most of the countries, major economies. So I think they're just looking at the effect of the wages on service prices of the CPI. And I think that's probably why Bank of Canada people didn't want to make any comments about the ongoing port strike, because last time when the governor mentioned that the businesses shouldn't expect inflation to keep rising, and then make plans for investment or employment. So that he actually came under fire from the labor.
Right.
And so I guess they're being careful about making a specific reference to employment behavior or wage hikes. Okay,
fair enough. Anything else on Canada you'd like to put in?
Well, I just wanted to ask something. It's not about Canada, but it was interesting from a briefing with Timothy Fiore, the chair of the ISM Manufacturing Business Survey Committee, which is in the U.S. But he said something about sometimes the soft landing can be more painful because there's this uncertainty, and just you have to keep guessing whether the economy is going to soft land or not, and then that's what's keeping businesses from making specific plans for investment and other things.
Yeah, fair point. I think when it comes to uncertainty, that's certainly a huge issue as far as, well, central bankers are concerned, investors and everybody else. All right then. Right, Max, before we let you go, let's go across to Japan then. We've been asking you on most of these podcasts what you think is going to happen at the next Bank of Japan meeting. And of course, we've got another announcement due next week. From what I've seen, it looks as if no change is expected. But as I keep asking you each time I speak to you, it does seem that the inflation numbers seem to be stronger than typically expected. So I guess we may well see the BOJ having to revise upward its inflation forecast. So at the very least, do you think next week we might see a slightly more hawkish tone coming out of them? Or indeed, do you think we could actually see something much more aggressive in terms of a tweak to the yield curve control parameters?
I think Governor Ueda, in his post-meeting presser, he's going to try to be more neutral. Neutral meaning paying attention to both sides. It's interesting that in India, after the G20 meeting of finance ministers and central bank governors earlier this week, he said the bank has continued with monetary easing patiently while paying attention to financial intermediary and market functions based on the recognition that there is still some distance before achieving sustainable and stable 2% inflation. And he said, I must say that unless that presumption is changed, the overall story will remain unchanged. That's a clear message to the markets, to the public that they're not going to make any big changes. And when it comes to tweaking the yield curve control, they raised expanded the range from 0.25 percentage points around 0 to 0.5. And that's because the upward pressure was so intense back then when most of the major central banks were still raising rates continuously. So, but compared to that situation, right now, I don't see too much pressure, upward pressure on the 10-year yields. So they may not have to make any adjustments right now. I don't know, going into the meeting next week, we're going to have to see the Fed results first. There's a lot of speculation in markets. I know that BOJ is going to do something, but I think in a meaningful way, I'm not sure if tweaking the yield curve control sends the right message, or I mean, there is an opportunity for them to make the band wider, but do they really have to do that?
Okay, fair enough. Let me ask about wages, because clearly one of the big issues, well, as with so many other economies in terms of inflation, what's happening to wage developments. But I saw, was it last week? I think it was at Rengo, and I apologise if I got the name wrong, but Japan's largest trade union. They were indicating that for 2023, unions had agreed to the largest pay increase. I think it's about 3.6%, the largest pay increase in some 3 decades. So, I mean, are the signs now that wages are actually starting to respond to the fact that perhaps the Japanese economy now is growing fast enough, whatever that actually means, to keep the labour market tight enough to put upside pressure on wages, or has this come some kind of anomaly?
That's a very good question, and I think it's an interesting development. At last, we're seeing significant wage hike, but the question is whether most of the companies that have to raise wages this fiscal year to secure workers, are they going to have to do the same in spring next year?
Right.
I'm sure that some of them will still have to, because the labor shortage in some sectors is still serious. But I think that's what the Japanese policymakers are a little bit worried about. Okay, this year, fine, the highest in 30 years, but what about next year? So until that becomes a little bit clearer in the early stage of the spring labor talks come out before March, I don't think, for example, the Bank of Japan people can be comfortable about achieving the 2% target in multiple years instead of just hitting it momentarily.
Okay, fair enough. Anything else you like to put in terms of Japan?
Yeah, it's also interesting that CPI, total CPI,
Mhm.
now both US and Canada's rates are below Japan, so that's an interesting thing. I didn't expect to see it, but
Not many
again,
people would, I suspect. Yeah.
again, it's just last year there was a spike in energy commodity prices. This year, that's a reversal. So it doesn't really show us the strength, just like Japan's first trade surplus we just saw
Right.
in like 23 months, but that's just energy commodities prices falling, so imports were down, and they didn't have to buy too much drug for COVID, and it doesn't really show the strength of the exports.
Okay, must say I do think Japan, and certainly for investors, dollar yen is going to be one of the interesting currency pairs to watch during the second half of this year. Brilliant. Okay, thanks for that, Max. Right, if we move on, well, I'll try and summarise the rest of Asia. Unfortunately, we haven't been able to get Brian on with us today, but it's probably just worth a while at least quickly mention China, where clearly there's still significant deflation risks abounding as far as investors are concerned. Looking at Econoday's economic consensus divergence index, which looks at how the economy in general has been performing versus expectations, that currently stands at -50, which means that forecasters have been significantly too optimistic about the overall stance of economic activity. And the inflation adjusted measure, which simply takes out, as it suggests, the inflation components, that's down at -60. So on the basis of way the economic numbers have been coming in over the last month or so, the Chinese economy has been well short of what the forecasters have been anticipating. Now, second quarter GDP growth in Japan on a quarterly basis was 0.8%, a little bit weaker than expected, but well down from the 2.2% we saw in the first quarter. Annual growth at 6.3%, that was down from 7.1%. And even then, the latest number was flattered by favourable base effects. So in broader terms, I guess for investors, the concerns are now that we are beginning to see signs that the expected, COVID or the end of COVID rebound is perhaps not materializing as quickly or as aggressively as people anticipating, and it's raising fresh concerns about whether or not the Chinese economy will be able to meet the government's forecast growth targets as far as 2023 is concerned. And I suppose one of the biggest issues at the moment is that there are increasing signs, particularly from the financial data, that businesses are paring back on investment in order to pay down debts. That, well, at least as far as some people is concerned anyway, is a classic sign that we could be looking at some kind of balance sheet-led recession. So in all broad terms anyway, at the moment, China still very much a place to keep an eye on in terms of concerns about knock-on effects for the rest of Asia with regards to growth, and ultimately also keeping down inflation as well. Indeed, just before I move on to Europe, it's worthwhile mentioning, I think, for as far as Asia is concerned anyway, Goldman's came out this week and noted that in terms of investor inflows, net inflows into what they call the ex-China emerging markets exceeded those actually going into China itself for the first time since 2017. So there are indications increasingly that investors are becoming increasingly negative in terms of how China's performing, and that's clearly going to have implications for global economies, commodity markets, so on and so forth. Okay, to my part of the world then, and Europe. Well, Eurozone economy is still very much underperforming expectations, and indeed significantly so. Our ECDI and the ECDI minus P, they've been consistently sub-zero since early May, and indeed basically consistently so. So being negative territory ever since, surprise territory ever since May, really does mean that forecasts have been far too optimistic about how the Eurozone economy is going to perform. GDP in terms of the hard data, we'll get some updates from some of the Eurozone bigger countries next week, but it looks as if after essentially no growth over the last couple of quarters, second quarter will probably see a small increase, but to all intents and purposes, economic activity across the Eurozone is pretty well flatlining. Now, that ain't going to matter that much, though, as far as the ECB is concerned, of course, because for them, it's still all about inflation. So the June CPI, or the HICP, as they call it in the Eurozone, the report there was mixed. The headline inflation rate was down to 5.5%. That was confirmed from 6.1% in May. So that's certainly a positive result. But the narrow core rate, which most of the financial markets tend to focus upon, that was up a couple of ticks at 5.5%. And indeed, just a couple of ticks short of its all-time record high. So the bigger picture, as far as the ECB is concerned, is that inflation, at least underlying inflation, remains far too high for them to do anything in terms of even thinking about reducing interest rates. And indeed, the market is pretty well convinced that when we get into the European Central Bank meeting next week on Thursday, we'll see yet another 25 basis points being introduced in terms of all the key official interest rates. I guess in line with many of the big countries at the moment, it's the buoyancy of prices in services which are giving the ECB all the problems. They're still accelerating. That's the big news, really. As far as June was concerned, we saw an inflation rate in the service sector of 5.4%. That was up from 5.0% in May. So a big increase in there. That's a new high, a record high, I should say. And they say, generally speaking, it's helping to hold up the core rates in particular. So do expect to see another increase in interest rates next week. But there are at least some signs that perhaps that could be the last. At the very least, tentative indications now that wages across the Eurozone have topped out and are probably starting to fall a little bit in some of the bigger countries. Underlying measures of inflation, I mentioned that the narrow core was up again, but some of the others suggested that perhaps inflation has topped out. So I think there's at least a chance that we're going to see the last hike in rates in the July meeting, if not then probably in September. But it does look increasingly as if, particularly with the economic data so weak in terms of the real economy, that interest rates for the ECB are very close to topping out now. Bank of England then, in terms of UK, my part of the world, where they're similarly widely expected to hike bank rate again. Their next meeting will be at the start of August. Last time round, they put rates up by fully 50 basis points, which was an indication of, if you like, almost how far behind the curve they have been. They've been doing 25 basis points for such a long time now. To introduce a 50 basis point increase was really seen by many, I think, as an indication of the fact that they're not exactly waving a white flag, but indicating that they really have got things wrong and underestimated just how strong inflationary pressures were. But I think particularly in light of what turned out to be a, well, I can't say overly positive, but let's say at least mildly favourable inflation report for June, where we saw the headline rate come down a good deal more than expected. That was down to 7.9% from 8.7%. And more importantly, the core rate, which came in at 6.9%, down from 7.1%, both rates weaker than expected. There are signs here too that it may be that economic growth has slowed sufficiently that it's now starting to impact some of the price pressures we've seen exerted in the UK for such a long time. So do expect to see another increase in UK bank rate, up another 25 basis points when we get to the meeting in the beginning of August time. But it could also be that we're getting close to the end of a tightening process there. It wouldn't surprise me if we saw another 25 basis points at the meeting after that. But again, it looks as if the peak to rates probably isn't too far off. All that said, as with so many other central banks, it's wage developments that the monetary authorities are looking at very closely. And we saw the government to some extent cave into industrial action over the last week or two. They've indicated that a lot of public sector workers, including teachers and doctors, they'll be getting pay rises of about 6% or so. That's following the government's decision to accept the recommendations of independent pay review bodies. So that's going to potentially put additional upside pressure on inflation. But the government's hoping that if they manage their fiscal side of the house sensibly, they'll be able to offset any kind of inflationary push by reducing some of the fiscal stimulus that the government's currently pushing into the economy currently. So have to wait and see. But as mentioned, looks as if interest rates aren't too far off the top. But at the same time, there's no indication of any chance of a cut in interest rates until we get well into 2024. Okay, then. I guess that's probably pretty well it as far as we're concerned for this week. What can we say in summary? Well, by and large, I think it's safe to say that global economic activity has certainly disappointed over the last month or so, and that's clearly be good news for getting inflation back down. But with labour markets pretty well everywhere still tight, don't expect central banks to take their foot off the monetary brake anytime soon. Economic data, of course, remain the key. And to this end, as we keep pointing out, please do make sure that you keep up to date with all the key economic data and the market moving events in Econoday's global economic calendar. On behalf of Terry, Max and me, thanks as ever for listening. We hope to see you again next time. Bye for now.